Okay, so in the beginning of the simulation, we decided on Cloud Shot. We thought it was a catchy phrase. We thought it would grab a lot of attention. And then we kind of made the advertising, the picture behind it, a cloud to kind of emphasize what our product name was going to be. So this is just our cover page. And then if we move forward to the next one, you'll look at our annual revenues. The red line is the UAV drones, the blue line is the cameras, and the orange line is the totals. If you notice, starting out at the beginning, our camera sales were a little bit better than our drone sales. As we continued to progress, the strategy that we had chosen, which was going to be the low-cost provider, throughout the duration of that started to work more for the UAV drones than it did the AC cameras. And we probably should have changed our strategy for the AC cameras, but we kept them the same, hoping that the cameras would sell themselves. But it kind of plateaued there at the end, and it just kind of stayed the same. If you look at the bottom, you'll see that our total revenues were $798,121. Our operating profit was $245,417, and our net profit was $171,301. And that is for the total all years combined. I'm done with this slide.
Could you move on to the next one? So this is our earnings per share. As you can see, it started off, from 5 to 6, it increased and decreased back to 7, but since then it increased, and at the end on the year, from year 13 to 14, it kind of plateaued in the middle, but from 7 to 13 we were able to increase our earnings per share a good amount.
Here is our return on equity. At the start of the simulation, we had a low return on equity, but throughout the year, we managed to get it on a high equity return standard. And we managed to get to that point by keeping up with our loan payments and rebuying our stock share on the market so that we can have more control on the company. Good, Ashley.
I switched it. It's on credit rating now. Jemiah
Messaged. She said she can't hear the.
Okay. She can't hear. Do we want to keep?
I cannot hear.
Okay. Should I keep going?
Yeah, I feel like we should. If she's having technical difficulties.
Okay, so this next one is going to be our credit rating. At the beginning, I think that the decisions that were made didn't really favor a company that would have a good credit rating. Our product wasn't all that great, and we were probably spending more money than we were bringing in. So if you look at the beginning, you can see that it starts out at a B credit rating. Throughout the entire simulation, the credit rating was managed by not taking out substantial loans, making sure that our end cash balance was going to be much higher than, we tried not to make it close to a zero, and making sure that we had absolutely no negative numbers anywhere. If you were to look at our ratios at the bottom, I think the highest that we got, and I could be mistaken, but I think the highest that we got was maybe like a 27 debt to equity ratio. So like a 27 and a 73, I think it was, if my math is correct. And like I said, a lot of that came from making sure that we weren't spending more than we were making. With low cost provider, it was hard to spend a lot of money because we were a low cost provider. We weren't raising our prices substantially. So we had to monitor how much we were going to spend, how much we were going to put into our product, if we were going to take out any loans, if we were going to put ourselves in a situation where Auto robotics was an option at one point in time, but the amount of money that it would cost to maintain those, I don't know that we were creating enough profit or money every single month or every year, to kind of keep up with that. And I think that, if I'm not mistaken, may have played a huge part in maintaining a good credit rating. If we would have had to take out a loan, our interest rate would have been great. So we've got that going for us.
So this is our stock price, and like the earnings per share slide that we showed, it decreased after reaching a point in year 6, and it also decreased in from year 13 to 14. Our stock price for year 14 was 223.29. So we kind of tried something different between the years 6 and 7, and then that affected us majorly. So we went back to what we were doing beforehand, and then it increased at 8, and then from 8 we improved upon that, went to 9, and then it slowly went up. But from 8 to 9 was kind of like the more drastic change in our stock price, and then we kept it increasing. Unfortunately, we lost a little bit at the tail end of our simulation, but we were still able to keep it above 200 since year 12.
The image rating. Our company managed throughout the year to keep up with a good image rating. And throughout the year, we gain our high image rating were in year 9. And then we start seeing a decrease on our image rating from year 10 to year 14. Actually, I'm good.
Okay. So our strategic vision was a low-cost provider. Our main goal was to provide a high-quality product to our customers at an affordable cost, in hopes that word of mouth, such as advertising and things, that will work in our favor as far as like the cameras. Hopefully, hoping that the cameras will be able to like sell themselves due to word of mouth. In recognition of our prices, we try to keep them at like affordable, fair prices to somewhat try to gain like a competitive advantage on our competitors.
Okay. So our future performance targets, throughout the entire simulation, they would continue to increase. I would say that by the first year, if the simulation were to keep going, I would definitely raise the earnings per share to $16.50. And I would raise the return on equity to 55%. In order to meet those, the earnings per share, I would probably be careful about what we would put as far as like money into our product. Unfortunately, being a low-cost provider when it comes to editing our product or making it any better, we don't really have a bunch of money to put into it to make it the best product on the market. So in order to continue to raise our earnings per share, we would just kind of have to be careful where we put our money. As far as our return on equity, I would raise that to 55% the first year. And the reason for that would be the more of the return on equity, like the more you get back, the more equity you have into your business. And one way that we were able to do that was to continue to buy our stocks back. Unfortunately, we should have done it like earlier in the simulation when they were a little cheaper. It's a little easier to raise your return on equity that way. But then again, the next year I would say we would increase earnings per share to $18.50 and our return on equity to 65%. If I'm not mistaken, in our simulation, our return on equity was something that we were able to maintain pretty well, actually. It was one of the highest numbers that we would have. Our credit rating, I would leave this at an A for us. It's done us well. And I mean, if we ever needed to take out a business loan, or if we ever needed something that would require credit, our interest rates would be good. We wouldn't be, given an arm and a leg for that. Our image rating for year one, I would raise to 83, just because we're a little behind the mark on that to begin with. Unfortunately, with low cost provider, we didn't have enough money to give back to the community or sustain the daycare, childcare during work hours, or provide safety at all times, or give back to the green initiative. We weren't able to do those things. So I would say that the expectation for the image rating, we would definitely have to raise and find a way to kind of meet that mark the first and second year after the simulation ended. So like it says at the bottom, to continue to be profitable, we would need to continue to set the high standards year after year. And just because we fell short in a few areas doesn't mean that we shouldn't raise those standards to begin with.
So our action capture camera strategy. Our strategy was, as we said before, a low-cost strategy. We didn't want to make too much changes that would change the cost of production. Not everybody would want to buy a very expensive camera. So if we're able to keep our costs low and sell it at a price that our competitors couldn't compete at, that'll give us a distinct advantage. We'd not put a lot of money into research and development, and we're relying on the products of other companies to see what our product could do, hoping that they would use the price difference, they would see the price difference and give our product a shot. So we wanted companies as well as our customers to look at what we were doing and thinking, oh, that's a good product that comes at a good price. They'll probably it's a good deal. People would search forever to find a deal as good as ours. That's what we wanted to put into people's heads, is we couldn't sell a product at a low price. Our strategy remained the same as far as region. The only difference is that we made was the budget for advertising in specific regions.
How are you a vision strategy? The approach that Cloud Shot Master took was that of low price as well. We would evaluate the industry average and use the competitive assumption tool to decide whether to raise the price on our products. We did not change our strategy based on geographic location. We did provide more discounts and exceptional warranty period for our customers throughout the entire simulation to ensure that our customer knew that their product would be replaced if damaged, given that they were more expensive.
Okay, so for our production strategy, our company maintained a good quality but base product throughout the simulations. As we previously had hoped that it could compete with those of higher prices, since we kept it at a fair price. We would make like small changes throughout the products occasionally, just to provide evidence for our company, and to see that if our company was growing and it could keep it up in the market as well. And then I think we would only expand if it was necessary, but to avoid like the increase of the cost of productions and things. But our goal was to not spend too much on like of our ending cash.
So compensation and training. So as far as compensation goes, I don't know that we kept up in the industry average the way that we should have. In the beginning of the simulation, we tried to maintain wages. Unfortunately, this goes back to that low cost provider strategy. When you have a low cost provider, typically you're not making as much money as the best cost provider or the company that has the greatest product for the most expensive price, and they're able to target that market where people will buy those products. Ours was kind of under the, like, we were going for the, not everybody's going to pay the extra penny for the better product in hopes that that would work for us. But unfortunately, it didn't in every area. And this is going to be one of those areas. So when it comes to compensation and training, we weren't able to keep up with other businesses in the market. As far as industry average, we were always a little below industry average until further in the end. We were able to, once we started buying back our stocks and kind of learning more about where money can go to make more money, and the understanding of sometimes you have to spend money to make money. As far as that, we were able to start putting more money into the compensation and training for our UAV drones. And the reason why for that was because that was our moneymaker. If you look back at our numbers, you'll see that, or even in the beginning of the presentation, the graphs that we were looking at when it came to like net profit, revenues and stuff, our strategy worked better for the UAV drones. So when it came to compensation and training and making sure there was no overtime and all of those things, the focus was more on those UAV drones because they generated more money. They were more expensive. The profit margins were better. Their percentage of the market share as it would go on was better. So we were able to drop more money into, at one point, you'll see that we started investing in research and development. Our fringe packets were better for compensation and training, or for UAV drones in the compensation and training area. Everything got a little better for our drones, not so much our cameras, unfortunately, as the simulation went on. And that was a direct result of the low cost provider. Unfortunately, we weren't generating as much money as we would have liked to. So we had to pick and choose what would be our breadwinner and what would bring us the most money, and UAV drones seemed to do that.
So throughout our entire simulation, we wanted to ensure that our debt to equity ratio was maintained at a 30-60 or less. We wanted this to happen so we were not at risk to not be able to pay off all of our liabilities that we owe. We didn't issue an incredible amount of stock throughout the simulation. Near the end, we started purchasing back their stock in order to raise our return on equity. Maintaining good debt to equity ratio and not taking out any loans helped us maintain an A credit rating. And that was throughout the entire project. We kept it till the end. We also didn't, unfortunately, start until late in the game dividends. It started at a 1, now up to 2. We could not afford to pay dividends to shareholders in the beginning. However, for the next 2 years after, we will intend to continue to pay our stakeholders. We may not increase immediately, but we could consider increase after we see a return from year 15 decisions.
Our biggest competitor. Action capture video is by far the strongest competitor in the market. They took the lead early on, and they have not slowed down or missed a beat. DAC, following their lead, also jumped into second place, putting us in third place early on. However, we would say that our biggest competitor that we go head to head with is better technology. they have been slowly catching up to us, and we are now tied in the market.
Okay, so our for the future strategy and actions for the AC camera. In the past, our strategy kept us like on a float in the industry. However, I think it's time that we raise our prices, not by too much, but just roughly $30-$50 more. That way than what we have been doing annually. Then I say that we will keep aggressive warranty periods to ensure the customers feel valued and confident in their products. We will also try to spend more money to improve our products in the market. We will increase the image sensor sizes, enhance some of the features like image quality, number of photo modes, and LCD display screens. And then we are also hoping that we will improve our product, and we'll eventually, once we get to improving the product and putting more money and quality in it, and we can like eventually set it at a higher price.
In the future strategy for the UAV drone, I would say that we would pursue somewhat of the same strategy in terms of price. I know that it says that advertising warranty periods and everything for the AC camera. However, I would probably say we should put more into advertising and warranty periods, just because like at the beginning, we discussed how they were a little bit more of an expensive piece of equipment. Therefore, if a customer wants to purchase, a $2,400 product, they're going to want to know that if something happens to it, that it's covered. So maintaining a warranty period, and a pretty aggressive one, that'll go a long way, especially in the eyes of someone who's buying something that expensive. I know that if I were to go to Walmart and purchase a $4,000 computer, I would want to know that if my $4,000 computer broke next week, that I'd be able to go to that company and be like, hey man, my $4,000 computer broke. What can we do about this? And that goes a long way when it comes to paying a high price. So if we were to increase our prices, I would say that our advertising would probably need to be increased as well. We would need to put a lot more into convincing and targeting specific markets and convincing them that our product is worth whatever price we're putting on it. The warranty periods, like I said, will also help that. We didn't improve too much of our UAVs throughout the simulation. We would make basic enhancements. We would increase a little by little. One thing that we didn't do was we didn't increase the built-in camera. We didn't mess with the GPI or the Wi-Fi or the Bluetooth capability. And the rotor performance was it was increased early on, and then it was left the same. If we're going to increase our prices, we also need to increase the quality of the product, which means the things that we didn't work on before, we're going to need to improve. Research and development is extremely important, and we didn't realize that until later in the simulation. We would probably spend a lot more on research and development that we did before, and that would allow us to research the market, the current market, the other companies in the market, what they're doing, how they're selling their product. What did they edit or fix last year that we didn't? Why are companies buying theirs more than they're buying ours? And that'll also help us develop our product. Like I said, that's something that we didn't focus too much early on. And then by the time we realized that, it was a little too late to put money into that. So hopefully that would help produce revenue. It would help. If it helps produce revenue, then we have more money to put into our product. The better our product gets, the more we can raise the price. And then the better our strategy might work.
So here are a couple of lessons that we learned. One of them was we shouldn't have waited till the later years to start making more drastic changes to our to the way we operated. Firstly, stock repurchase. If we'd done it at the beginning, that would help. That would have helped us raise our ROE and EPS as it did in the last final years that we were able to start doing that. We needed to stop. We need to stop depending on low cost. Sure, a customer will purchase something at a price they think is reasonable, but we are not able to raise our prices unless we raise the cost of making them. We should have spent more in research and development so we could understand what people would like and how to improve all of our products. We should have spent more time and more effort on that, which would have cost more money, arguably, yes, but in the same time, we could make a product that would be um, more expensive to produce, but then again, we'd be able to sell a lot. We could sell at a lot higher of a price. And the last lesson, we should have contributed more to the community and paid our employees better to improve our image quality, image rating. That an area that we struggled to increase annually as the project went on.